Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, Dave Meets and Dave Sequeira discuss oil prices. Russ Kinnell highlights what has suffered and what has persevered through recent volatility. Christine Benz shares personal finance tasks investors can do for their portfolio while the world is on pause. Russ Kinnell examines funds that held up better than others during recent market turbulence. And we offer guidance on how to navigate the current market crisis. So let's get started. Dave Meets and Dave Sequeira discuss oil prices.
Good afternoon. This is Dave Sequeira on behalf of Morningstar. With me this afternoon, I have David Meets, Director of Energy Research at Morningstar's Equity Research Group. David, thank you very much for taking the time to speak with us today on the current state of the oil market.
Sure. Happy to be here.
Over the past 30 years, sometimes I think I've seen it all in the finance business. But just most recently, we've seen something that's never happened before. We saw oil prices trade at a negative dollar price. Now, oil prices have been under significant pressure for a while now. But to start us off, could you maybe explain to us exactly what is a futures contract, who utilizes futures contracts, and why?
Yeah, absolutely. So a futures contract is a financial product that requires an investor to take delivery of a commodity for an agreed upon price at an agreed upon time in the future. And it's usually used by companies in the related industry. So for example, an oil producer might want to use these contracts to ensure that it doesn't sell its future production for too little. A refiner might want to use the contracts to ensure that it doesn't pay too much for the crude that it uses as an input in the future. But commodity speculators can also use these contracts to make bets on the direction of movement of crude prices.
And can you explain to us, where exactly did the May monthly contract trade to, and why did that occur? Were there certain technical reasons behind that?
Yeah, so yesterday the contract for WTI crude delivery in May dropped from $20 a barrel to negative $38 a barrel. The first time it went negative. That's a decline of 289%. And the reason for that decline is that the contract was expiring today, and investors were getting worried about the potential for crude oil storage at the Cushing hub in Oklahoma, which is where WTI is priced. So the fear is that if you buy the contract, then you're on the hook to take delivery of that crude oil at some point during the month of May. And if there's no storage available at that time to take the physical delivery, then you have to find some alternative solution, some alternative storage elsewhere, secure transport for that physical crude, and that can end up costing way more than the negative price of crude yesterday. So in effect, investors were willing to say, "Hey, I'll pay you $40 to avoid this risk and to not have to worry about whether I can scramble to find storage." And of course, the reason that storage is getting full is that gasoline consumption and therefore crude oil consumption is very low right now due to the social distancing that's widespread as a result of the coronavirus. So it's a short-term thing. That's why the impact was mainly constrained to the contract for the month of May. At least for now, the impact further down the line, further into the future, was a lot less.
And now that the May contract is expiring and we're rolling to the June contract, what do you see going on with the June contract? And how far out into the future do futures contracts trade? And in your view, where do you see mid-cycle oil prices in the future?
So the futures contracts trade out for years until the late 2020s, and the impact on pricing was less yesterday the further out in time that you go. So the biggest impact was for the May crude contract, which took a hit of negative 289%. The next contract in line, the June contract, which is now the front month contract after the expiration of the May contract, that front month contract for June declined only 20% yesterday, so a lot less than the 289%. And by the December, the impact was only about 2%. So a big difference the further you move out in time. And what we see now is that the long-term crude prices are still hovering around the $20 a barrel level for WTI, and we don't think that's enough in the long run to incentivize oil producers to keep drilling and to keep increasing production. So if the U.S. shale producers responsible for about 10% of global supply say, "Hey, these prices are too low, it's not worth us continuing to drill here," then that production will decline really quickly, and what is currently a pretty painful glut will turn into a shortage down the line unless prices recover to that $55 a barrel level to incentivize the shale producers to keep drilling.
And thinking about, the movement in the prices today versus where you think prices should be going, over the course of the next few years until we get to more of a mid-cycle price, how does that impact the valuation of stocks for oil companies, that concentrate on exploration and production?
Yeah, so we think that the mid-cycle price is about $55 a barrel. That reflects the marginal cost of production for shale producers, and that's kind of the level where the shale industry would where that business model would be sustainable over an extended period of time. And of course, today prices are well below that level, and even the implied prices from the futures market still shows prices well below that $55 a barrel level as you go out several years into the future. And we don't think that's realistic because the shale industry will not go to work under those conditions, and then you would end up with a shortage instead of a glut. So we think that prices will have to improve, and that's really good for energy companies. So we think that energy stocks in general are undervalued. Of course, the caveat is that an energy company, to benefit from an increase in prices 2 or 3 years down the road, has to be around in 2 or 3 years. And this is, of course, a very painful downturn. So we look to prioritize companies that have really strong balance sheets and have the wherewithal to tolerate a period of very difficult crude prices if necessary.
And along that note, which companies do you think specifically are best positioned to be able to weather this current downdraft?
So two examples of E&P companies that have really strong balance sheets and are not at risk in our view in terms of financial health in the next couple of years would be EOG, the ticker is EOG, and Pioneer Natural Resources, the ticker is PXD. Both of those companies we think are very high quality companies with above average margins and profitability in general, and both have very strong leverage ratios as well, good financial health, and very strong balance sheets. So EOG and Pioneer would be two names to bear in mind.
Well, David, thank you very much for sharing your insights and sharing your perspective with us. For more research and insights, please visit Morningstar.com. Thank you.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit Morningstar.com/Alexa. Now, Russ Kinnel highlights what has suffered and what has persevered through recent volatility.
Hi, I'm Christine Benz from Morningstar.com. Russ Kinnel, Morningstar's Director of Manager Research and Morningstar Research Services, has been following investments for more than 25 years, but even he has found some aspects of the market's recent volatility to be surprising. He's joining me here today to discuss them. Russ, thank you so much for being here.
Glad to join you.
We've been doing this for a long time, Russ, but I don't think either of us has ever experienced anything quite like what we've been going through recently. So you highlighted some things that you did find particularly surprising about the recent volatility. One market segment that was hard hit, especially when stocks were falling recently, was the municipal bond market. Let's talk about why munis did fall so much during that period, and whether you expect them to claw their way back.
Yeah, I was definitely surprised early on because early on we had a flight to quality in which we saw treasury bonds, so the federal government's bonds, rally really strongly, especially at the long end. But at the same time, munis were actually selling off. So state and local government debt was selling off. And early on, a lot of the explanations were kind of technical, like just there wasn't a lot of support, their liquidity had dried up. Uh, But I think over time, it became more clear that it wasn't just technicals like that. There was actually some good fundamental reasons behind that. And that is, as we've seen how hard hit the economy is and what strains the states are under, all of a sudden, all their tax revenues have gone away, but they're also scrambling to, support all the people who have lost jobs, as well as support the healthcare workers with, gear and ventilators. And so when you look at it that way, it makes a lot more sense that munis would be under strain because the federal government can print money. Their debt's not going to default, but it's a tougher spot for munis. Now, historically, munis have done very well, and there have been few defaults. But I guess what I'm saying is I do understand the strain that they're under.
So one, I guess, benefit having come through this is that munis now have better yields than they did going into this period of volatility.
That's right. So now you're getting a better yield. At least you're getting a little better payoff. I think munis are a decent buy now, but not super attractive. They've sold off some, and there really is a tremendous strain under munis. Interestingly, we're talking about bailing out a lot of different uh, parts of the economy: cruise lines, airlines, hotels, the auto industry, but states and local governments have not really been in the discussion.
Good point. So another surprise area for you, again, in the realm of negative surprises, was just how badly financial stocks have gotten hit. So let's talk about some of the factors going on there, things working against financial stocks.
That's right. Compared with 07, 08, financials came into this crisis in much better shape, much less leverage, higher paying. Their loans were being paid, so they came into this situation in much better shape, and yet they're still getting hit really hard. I think a big part of that, of course, is just the economy has been hit really hard, and so financials are definitely feeling the brunt of that. That a lot of the loans across the board, not just in one sector, but are not going to get paid back, or are not. They're going to be, people will miss some payments, and so financials have really taken it on the chin. And again, a little like munis, with hindsight, we can see why that is, and there's some good reasons for that. But again, you wouldn't have predicted that going in, or at least certainly I wouldn't have.
Right. Now, over on the other side of the ledger, in terms of more positive surprises, growth stocks have surprised you a little bit because they have been relatively strong throughout this market swoon.
That's right. If you look at the pattern we had established before this, you had a great growth stock run up in the 90s. And then when we had a bear market, leadership flipped to value stocks because, of course, they seemed a lot cheaper. And then that switched again when we came to the 08, 09 bear market, where value had been leading. It switched to growth. But this time, it's actually, the growth has just kept on doing well. It's kept, at least relative to value, the gaps have actually grown a fair amount between growth and value. And again, I do think there's some logic here. Obviously, a lot of the hardest hit industries, economically cyclical ones, are on the value side. We already talked about financials. We know energy is having a horrible time because of oil prices. So there is a logic, and at the same time, what are we using more? We're using Amazon and Google a lot more. So again, there is some logic that growth would, in general, held up better than value, even though, again, you wouldn't have predicted that.
Okay. Speaking broadly, you say the strength of the recovery, the market recovery, has surprised you a little bit. I think on a total market index are down like 11 or 12% currently here in mid-April. That seems like a really robust recovery, I guess, given that some people are talking about potentially us entering into a depression.
Yeah, it really is surprising. Think again, we go back to the previous two bear markets, and in both cases, you really overdid the selling. So long past the point where it seemed like a reasonable point to stop, where it seemed like all the bad news was out, stuff just kept getting cheaper and cheaper. This time, we've had a really tremendous rally. And again, yeah, if you think about it, uh, we were near all-time highs just a couple months ago, and for us to only be off 13% for the year to date is remarkable, considering the economy is going to be in a rough shape for a long time. I think we're not just going to spring back like in a month or two, and so yeah, I do think it's a little odd that the market right now does not is only down slightly. It's pretty modest sell off at this point. Now that you factor in, we had a huge one of the fastest 30% decline, but now we've recouped a big chunk of that. And so it really is surprising. And when I think about it at this point, if anything, I'm more inclined to sell than buy.
I suspect that there will be more surprises in the days and months ahead. Russ, thank you so much for being here. It's always great to get your perspective.
You're welcome.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Christine Benz shares personal finance tasks investors can do for their portfolio while the world is on pause.
Hi, I'm Susan Jabinski with Morningstar.com. During the current COVID-19 crisis, some people are finding themselves at home with a little extra time on their hands. Joining me today to talk about some financial tasks you might considering knocking off your list while you're at home is Christine Benz. Christine is our Director of Personal Finance at Morningstar. Christine, thank you for joining me today.
Susan, it's great to be here.
Now, we'll first start by saying, of course, there are plenty of people right now who are busier than ever, so they don't necessarily have the time on their hands that we're suggesting. But if you are at home and you do, you're saving yourself a commuter, or for whatever reason you find you have some spare time, one financial task you suggest knocking off that list is doing your taxes. Now, we have until July, so why do you think that's something that should be on the top of our to-do list?
Well, obviously, if you're getting money back, you don't want to delay filing. Get that return in as soon as possible to expedite your return. If you are owing, I still think it's worth figuring out what you owe. You'll ultimately wait until July to file your return because you don't want to have to pay any sooner than you need to. But take your time to figure out what you owe. And also, if you do owe maybe more than you expected, it'll give you some time to think about where you'll go for funds to pay your taxes and potentially budget for them in advance.
Now, you also think, Christine, that now is a good time for us to sort of go through our financial paperwork and get things organized.
Right. I've been banging this drum for a while, but in my experience, people hang on to way too many paper documents. It gives them filing headaches, and it also exposes them to more identity theft issues than would be the case if they were receiving electronic document delivery. So if your financial providers have been badgering you about going paperless, it's time to take them up on it. Check those boxes. You may even actually be paying to receive physical paper documents. So you could save a little bit of cash every month. And then once you've done that, go the extra step of culling the paperwork that you have hung on to. So go through your files. Chances are you're saving way more than you need to. I often see people save shareholder literature like annual reports and prospectuses. So you can get that stuff out of your filing cabinet and create a system that will be more skinnied down. And of course, you want to save any very difficult to replace documents in a safety deposit box outside of your house, ideally.
Now, related to do here, Christine, would be creating some of these documents, these larger overarching documents that we should have that address our investment and financial plans. What would those be?
Absolutely. So a few of the ones that I would call out would be what I call a master directory, also an investment policy statement and a retirement policy statement. So starting with the master directory, that's simply a guide to the investments that you own, where you own them, maybe the approximate account value, account number, and you want to password protect this document or encrypt it and share it with someone who could need access to your information in a pinch. So it's a way of inventorying all of your assets and having it in a streamlined sort of document that someone could take a look at if they needed to, if there were some sort of a financial emergency. An investment policy statement is another document that I think every household where you've got investors should have. And the basic idea is that it's a blueprint for your investment plan. So it lays out your asset allocation plan. It lays out your approach to reviewing your investments on an ongoing basis. So it documents how you will choose and monitor your investments on an ongoing basis. And finally, a retirement policy statement is something that I recommend that all retired households have. And the basic idea there is that it lays out your system for generating income in retirement. So it lays out your system for cash flows from your portfolio, what your withdrawal rate will be, how you will generate cash from your portfolio. You might include some details about your approach to Social Security and any other non-portfolio income sources as well. So those are really the big three documents that I think every household should have to document their financial and investment plans.
And lastly, one thing that often falls to the bottom of our to-do lists is creating or updating our estate plans. So what should we be thinking about there?
Right. This is one that seems to get pushed down to the bottom of everyone's list. And the fact is, it's not any fun to ponder our own mortality, but it has been top of mind recently as we've been monitoring the current crisis. So if you don't have an estate plan, you can either use some sort of an online resource, and there have been many that have popped up in recent years, or turn to an attorney. And I believe that many of them are now doing video conferencing. So you shouldn't use the current shelter in place rules as an excuse to put this off, because chances are you'll be able to find someone who will work with you. And so you're really looking to get the basics hammered out. You're looking to have a will. If you have minor children, you'd certainly want to have guardians specified for them. We all need to have powers of attorney, so people who will make financial and healthcare decisions on our behalf if we're unable to make them. A living will is another essential document to have. So check in with an attorney, or if you have a very simple sort of estate plan, you may use an online resource. But this is something to focus on, especially if you find yourself with a little bit of extra time. Another thing that I would add under that estate planning heading would be checking up on your beneficiary designations, because many of our assets do pass through beneficiary designations, and those actually supersede what you may lay out in your will. So definitely attend to those beneficiary designations. If you had an estate plan that made sense for you 10 years ago, there may have been some changes in your life. So check up on it to make sure that it still syncs up with your current situation.
Well, Christine, looks like you have a lot of smart and important things for us to do to fill our time that we have if we're at home these days, other than, streaming videos and watching movies.
Right.
So thank you for your time, Christine. It's always a pleasure to talk with you.
Thank you so much, Susan.
I'm Susan Jabinski for Morningstar. Thank you for tuning in.
Now Russ Kinnel examines funds that held up better than others during recent market turbulence.
Hi, I'm Christine Benz from Morningstar.com. Equity funds as a group have struggled recently, but some funds have behaved better than others. Joining me to take a look at some funds we like that managed to hold up much better than their peers during this recent volatile period is Russ Kinnel. He's Morningstar's Director of Manager Research in Morningstar Research Services. Russ, thank you so much for being here.
Glad to be here.
Russ, let's just start by talking about the benefits of funds that can hold their ground during periods of volatility. You spend a lot of time looking at how investors behave with their funds, and it seems to me that your research indicates that people do hang on to these lower volatility funds a little more than they do other fund types.
That's right. The higher risk funds, though they generate excitement, they also generate a lot of fear, and people tend to do a less good job with their timing. It's hard to hold on in a downturn like this if your losses are actually worse than the market. So these defensive funds, these funds with a little less volatility, tend to work out really nicely for us.
Okay, so let's highlight a few of them. Foreign funds were generally hit harder than U.S. during this period of recent turbulence, but First Eagle Overseas was one that was really able to limit its losses. It held up much better than other foreign large cap value funds. What worked for it?
Yeah, this is a fund that's always kind of made its name on defensiveness, and it really has three ways of being defensive. It holds a big cash stake, it holds a big stake in gold bullion, and it owns value stocks to protect against price risk. Well, in this case, those first two worked great. The third one, having a value tilt, did not work. Value has gotten hit, but 2 out of 3 is sufficient for it to have lost a lot less than most of its peers.
Okay. And coming into this period of market volatility, my guess is because of some of those same factors, it probably wasn't looking that great relative to its peers.
That's right. Cash and gold have generally not been great places to be in the last decade, and even value has not been the best place to be. But again, that's why you see a good fund like this can, over a full market cycle, actually give you a really nice risk-adjusted return. But of course, you have to have the patience when it's out of favor. Otherwise, you kind of miss out.
Right. Now let's talk about American funds, American Mutual. This is a large cap value U.S. focused fund. Value stocks too have struggled. What has helped this fund outperform its peers?
Well, for starters, it typically holds a bit of cash. It's got about 11% in cash. And of course, cash is much better than equities these days. But it's also the way they invest. They have a focus on dividend payers, and the dividend payers have to be investment grade. And of course, in a downturn like this, the dividend payers that are not investment grade, people may sell their stock because they think they're going to cut their dividend. But really, this discipline of dividend payers that are high quality means you're in more defensive names that hold up really well. And on top of that, the fund has had modest sector tilts relative to peers towards tech and healthcare, away from financials. And of course, those have all helped.
Another fund that has held up well, not just relative to its peers, but also relative to the broad market, is Artisan Midcap. Let's talk about what has worked so well for that fund so far this year.
Yeah, I'm really impressed by this fund. It's only down about 4.5% through April 14th, so you'd hardly even know a bear market was happening. Again, you have an emphasis on quality, good balance sheets at this fund, and that's really helped it a lot. It's also got a nice tilt towards tech and healthcare and away from all the value sectors that have been hit hard. And it's, again, a fund that generally has a nice track record of holding up well in down markets. So I'm really impressed by this one.
Okay, Russ, it's always great to get your perspective. Thank you so much for being here.
You're welcome.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Expand your investing horizons and look to the long view with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. And lastly, we offer guidance for investors while they navigate the current market crisis. In February of 2020, most global stock markets were trading at or near all-time highs.
Another record day on Wall Street, as the snazzy animation says.
Then,
the number of cases of COVID-19 outside China has increased 13-fold.
Todos los trabajadores de actividades no esenciales deberán quedarse en casa en las próximas.
We will be denying entry to Canada to people who are not Canadian citizens.
Das Coronavirus breitet sich weiter mit besorgniserregender.
Hundreds of thousands of people have left the labour force, left the workforce.
संपूर्ण लॉकडाउन होने जा रहा है.
We will be extending our guidelines to April 30th.
It's easy to think that this market crash only affects the wealthy. But across the developed world, hundreds of millions of average citizens invest at least some portion of their savings in the stock market. And if they've looked at their statement recently, they'll see that they've also been hit hard. The circumstances of this market crash are unique to the coronavirus pandemic. But are such drops normal? Was anyone expecting this? What should an investor do now, and how can an investor prepare for the next crash? The global financial crisis and subsequent market crash that ended in 2009 has been described as a black swan, a unique negative event that could not be foreseen because no similar events had occurred in the past. However, if we look at historic data, we can see that there is a long history of market crashes. Financial researcher Larry Siegel came up with a more fitting term, black turkey, an event that is everywhere in the data, it happens all the time, but to which one is willfully blind. Between 1871 and March 2020, we can see 17 black turkeys in the US, which would be market declines of 20% or more. That means a black turkey happens about once every 9 years. The pattern is similar in almost all developed markets. Now, this isn't to say that anyone could have or should have seen this market crash coming. And the good news is that markets have always recovered and gone on to new highs. The bad news is that no one knows how long it will take to get to those new highs.
It's perfectly natural that right now people feel unsettled, both because of the reality of a global pandemic and the wild swings in the market that we've seen, and also because of how our minds are wired. When the markets drop 10%, right, and we've seen up and down, but when they go down 10%, it's natural to think that they will continue to go down. And so we worry about that. We worry about what that means for our livelihoods, what it means for our portfolios and our ability to retire comfortably.
This may make some investors want to sell out of stocks completely. However, most investors should not make drastic changes. If we look at a U.S. investor who sold out of stocks in 2009 and then reinvested 1 year later, we can see that they ended up with much less return compared to someone who stayed invested.
If you encounter market volatility and you expect to need money within the next, say, 2 to 5 years, it's probably not too late to reduce your equity allocation. Yes, in a lot of ways, you're locking in losses, but the idea is that you're de-risking that money that you expect to spend soon. On the other hand, for funds that you won't need for a while, say 5 or 10 years or even more, probably want to leave those invested in stocks, let more of your portfolio heal and grow for the future.
An investor's behavior in volatile markets often works against their long-term plans. What can an investor do to keep their behavior in check?
First, we want to externalize our own rules, how we want to respond, and what we value in investing. So write out your goals, write out your rules. I trade under this price to fair value, etc. Second, take that and create a commitment around it. So signing it matters. It makes a personal commitment, signing that statement. You can also make it a social commitment by giving it to your spouse, giving it to your advisor and saying, these are the rules that I want to follow. And then third, we can use that and other techniques to add friction. So setting a cool down period before making any major changes, say a 3-day window after which it's okay to make a change, but you have to wait those 3 days to think clearly about the changes you want to make.
Black turkeys are unsettling, but they are an expected part of investing. If you focus on controlling your own behavior, matching your mix of investments to your time horizon, and maintaining a focus on the long term, you can weather this market crash and the next one, ultimately reaching your financial goals. That does it for this week's Investing Insights podcast from Morningstar.com. We hope you've enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.